Okay, let's jump right into this explainer on IAS 36. If you're studying accounting, you already know your way around a balance sheet, so today we're exploring a fundamental reality check. And that's the principle that assets should absolutely never be carried at a value higher than what they can actually generate in the real world. It's basically the ultimate anchor keeping corporate asset valuations grounded.
Think about it like this. What actually happens when a $1 million factory yields only, say, $1,000 returns? Well, that question gets to the absolute core of why impairment testing even exists. Overstating assets completely misleads investors, creditors, the whole market. So we need a strict mechanism to drag those overly optimistic values back down to economic reality. And that is exactly what IAS 36 does.
To make this dense standard a bit more digestible, we're going to break our journey down into 5 main parts: foundations, measuring the recoverable amount, recognizing losses in CGUs, reversals and disclosures, and we'll wrap up with amendments and a summary.
All right, let's kick things off with Part 1, the foundations of IAS 36.
So the crucial takeaway here is that impairment acts like a ceiling check. You look at your carrying amount, your cost minus accumulated depreciation, and you compare it to the recoverable amount. IAS 36 is there to ensure an asset's book value doesn't outpace its true current economic worth, because if it does, you've got an impairment on your hands.
Now, we need to call out a major exclusions block right away. IAS 36 is incredibly comprehensive, sure, but it politely steps aside if an asset already has specialized valuation rules. So, inventories are out, they use IAS 2, deferred tax assets use IAS 12, employee benefits fall under IAS 19, and financial instruments have their own highly specific models under IFRS 9. Another foundational concept we absolutely have to lock down is the CGU, because, let's be real, a single machine or a standalone patent rarely generates revenue entirely on its own, right? So, IAS 36 groups assets into a cash-generating unit, or a CGU. This reflects how businesses actually operate in the real world, looking at the absolute smallest group of assets that independently generate cash.
And looking at our standards linkage block here, you can see how brilliantly interconnected the whole IFRS ecosystem is. IAS 36 doesn't calculate fair value from scratch. No, it relies heavily on IFRS 13 for those fair value measurement blueprints. And it looks over to IFRS 3 business combinations to supply the baseline metrics for things like goodwill before it steps in to test them for impairment.
Moving right along to Section 2, let's talk about actually measuring that recoverable amount.
The good news here is you don't have to run an impairment test on every single asset every day. That would be a total nightmare. Instead, at the end of each reporting period, you act like a detective. You're looking for specific external and internal triggers. Maybe an unexpected drop in market value, a new law restricting your product, or a key machine literally breaking down. Those are the red flags that prompt a formal test.
But wait, we have a massive exceptions block here, and you need to be extremely careful with this one. Goodwill. Intangible assets with an indefinite life, like a major brand name or software that's still in development. These completely bypass that indicator check. Because these assets are inherently riskier and way harder to value, the standard absolutely demands a mandatory annual impairment test, whether you see warning signs or not.
Which brings us to the core measurement showdown. When you do run a test, you determine the asset's recoverable amount by picking the higher of 2 options. Option A, selling it off right now, which is your fair value less costs of disposal, or Option B, keeping it running and milking it for cash flows over its remaining life, which is its value in use. Whichever number is higher, that is your recoverable amount.
Now, if you choose to model out that value in use because it gives you the higher number, Appendix A of the standard strictly dictates your math. You have to use pre-tax discount rates, you absolutely must exclude financing activities, and crucially, you have to exclude any future uncommitted restructurings from your cash flow projections. You are measuring the asset based on its condition right now, not some hypothetical, shiny future state. Okay, Section 3, recognizing losses and dealing with those CGUs.
Let's look at a fictional company, Global Widget Co., to see the math in action. Their factory's carrying amount is $1 million. The higher of our 2 recovery options is the value in use, coming in at $750,000. So the balance sheet value has to drop to match that $750,000, meaning we recognize a $250,000 loss. That hit goes straight to the profit or loss statement, and it's going to adjust all future depreciation schedules for that factory.
But what happens when that loss applies to a whole group of assets, a cash-generating unit?
Well, when an entire CGU takes a hit, there's a very strict order of operations. First, you wipe out the goodwill. Goodwill is the most subjective asset, so it takes the very first blow. Then, and only then, if the loss is larger than the goodwill, you take the remaining loss and spread it pro rata across the other hard assets in the unit. But hold on, check out this exceptions block. During that pro rata allocation step, you cannot force an individual asset's value below its own known fair value or value in use. You basically establish a floor. So if a specific delivery truck inside the CGU has a known fair value of $50,000 on the open market, you can't write its carrying amount down to $30,000 just because the CGU math says so. You cap its loss at the floor and spread the rest to the other assets.
Now here's a standard linkage that is frankly pretty fascinating. When you have a partially owned subsidiary under IFRS 3 and 10, and you measure the non-controlling interest at its proportionate share of net assets, the parent's balance sheet doesn't actually show 100% of the goodwill. So before you do your impairment test, IAS 36 forces you to mathematically gross up the goodwill to a theoretical 100% just to make sure you're comparing apples to apples.
All right, Section 4, let's look at the aftermath, reversing losses and telling the market what happened.
So what if the economic clouds finally part? Technology shifts back in your favor and value actually returns. Well, you can indeed reverse a prior impairment loss, but there's a strict ceiling. You can only reverse the loss up to what the asset's original depreciation schedule would have been. You definitely cannot use a reversal to magically revalue an asset above its historical cost carrying amount.
And here is the absolute mic drop rule of IAS 36. This is a massive exception. Once goodwill is impaired, it is permanently dead. It is strictly forbidden from ever being reversed. Why? Because the accounting standards view any subsequent increase in recoverable amount of goodwill as internally generated goodwill, which is never, ever allowed to be recognized on a balance sheet.
Obviously, transparency is absolutely key to financial reporting, so the standard mandates rigorous disclosures. It is not enough for a company to just drop a massive loss on the income statement. Management has to explain the real-world triggers, and more importantly, they must expose the discount rates and growth assumptions they use to justify their valuations, allowing analysts and investors to judge if the math was maybe a little too optimistic.
And finally, Section 5, bringing it all together.
Look at this consolidated linkage map. It perfectly visualizes how IAS 36 acts as the ultimate guardian of the balance sheet. It takes the initial asset values from IAS 16 for property and IAS 38 for intangibles. It pulls goodwill figures from IFRS 3. It utilizes fair value metrics from IFRS 13. By sitting right at the center of this web, it ensures that no matter how assets are acquired, they're all held to the exact same reality check. So, I want to leave you with this final provocative thought as we wrap up this explainer. An impairment loss might look absolutely terrible on today's income statement, heavily impacting short-term profit. But think about it. Does delaying the inevitable and keeping artificially bloated assets on the books actually destroy long-term investor trust? Does it mask the true operational reality of the business? Understanding IAS 36 isn't just about accounting compliance. It's about evaluating the genuine, honest quality of a company's earnings. Keep that in mind, and you will start seeing the numbers in a whole new light.